Hello everyone, this is Ruben Galindo with San Antonio's Finest Realty. I'm excited to announce that I'm going to begin 1-minute educational videos. And in this first video, I'm going to explain how the debt-to-income ratio is calculated. The debt-to-income ratio is also known in the mortgage world as the DTI. The DTI is calculated by adding all your financial obligations divided by your gross income. Here's an example. Okay, here I came up with an example. Let's start right now with the total income is $10,000. Here I have the debts listed. We have a $1,500 mortgage, a $500 car payment, and a $100 credit card. You total those debts together, that your total debts equal at $2,100. So now you have to take that $2,100, which is your monthly financial obligations, and you divide it by your monthly income. When you do that division, you end up with 0.21. That translates into 21% DTI, debt to income ratio. Now keep in mind that if you don't have a mortgage, let's say you live with a family member, with a parent, or whatever that case may be, you can go ahead and eliminate this $1,500 from this calculation because you wouldn't technically have a mortgage obligation. And of course, that would translate to a $600 financial obligation, which definitely impacts this, makes the debt to income ratio even lower. So let's expand on this. Let's say you're interested in becoming an investor. You're looking for a new investment property. Let's use these same numbers. The total debts, like we calculated earlier, was $2,100. You've already found a property, you've identified it, you kind of have an idea of what your APR is going to be, and your mortgage lender broker has already calculated that your financial obligation for that new property or your new mortgage is going to be $1,000. And let's just assume that that includes taxes and insurance. When you add that extra $1,000, now your new total becomes $3,100. So now you have to calculate your new debt to income ratio. In this example, $3,100 divided by $10,000 income equals 0.31 or 31% debt to income ratio. Very simple math. It doesn't take a whole lot to calculate that. After explaining this example, typically the next question is, what is considered a high debt to income ratio? That is a question that you need to ask your mortgage lender because there's many variables that can impact that. Credit scores. Obviously the higher the credit score, typically the higher debt to income ratio you can have. My personal experience has always been when I'm trying to acquire a new investment property is I try to stay at that 43% or lower. Now, I'm not saying that 43% is what it takes to get approved. Again, there's other factors that may factor into that. That is a question that you need to pose to your mortgage lender or to your mortgage broker. But at least this kind of gives everyone an idea on how this works. Again, this is Ruben Galindo with San Antonio's Finest Realty. I hope you learned something today. If you have any questions or comments, please comment on the box below. And I will see you at the next Minute of Education for a Lifetime of Equity.